Yo, what's going on, people? It's Curtis back with another investment video. If you don't know what to do because you're new, please make that like button go blue. Please smash that subscribe button. I'm still on a mission to get to 1,000 subscribers. Probably won't do it by the end of the month, but however fast I can get to 1,000 subscribers and hit that milestone, I'll be greatly appreciative of all of you guys that have subscribed to the channel and been on this journey. I'm already appreciative, to be honest, but I would continue to be appreciative, shall I say. So yeah, hit that subscribe button if you're new to the channel. Today I wanted to do a very emotive topic, potentially a controversial topic on, is long-term investing really worth it? Is it worth it? Genuinely, is it actually worth it? And I know that might ruffle some feathers, but I think it's an important discussion to have. Now, I'm a very reflective person by nature. In all aspects of life, I like to reflect on things, and I think the stock market is no different, and in fact it's probably best placed. So obviously you guys know at the beginning, I created my dollar cost averaging strategy. I didn't create the strategy, it already existed. I used the dollar cost averaging strategy, and I used my methods in terms of how I select stocks, and then obviously have been investing ever since and been giving you guys portfolio updates, blah de blah de blah. And so I wanted to do a video today to kind of look back on, if I put all of the money in up front as opposed to dollar cost averaging, what would be my difference in return now versus had I made that move instead with the same stocks. And also, if I put the money in, say, a cryptocurrency or something else that I genuinely wanted to invest in as well and have invested in. So not just sort of arbitrarily, oh, if I invested in Bitcoin, I would have made this much. That's not the type of thing I'm talking about. I'm talking about specific coins that I genuinely planned to invest in previously, but chose to go down, the long-term investing route, and explore that as well. So I really want to kind of compare and, just look back and actually see, is this whole game worth it? Is it genuinely worth it? So, I think you guys should stick to the end of the video and then definitely let me know your thoughts in the comments. Before I get into it though, let's backtrack and have a look at this year so far. So you guys know I've been investing since December 2018. It's now May, the end of May. And so that's been 6 months. So it's a nice 6 month period to kind of be reflective and sort of look back on progress and reassess. And what's happened in that last 6 months, from an economic standpoint? Well, if you're watching from the UK, I think it's been a very turbulent 6 months. You've obviously got Brexit, the shit show that's been, to be honest. And then you've had, there was an incident in March, where the FTSE100 saw its worst day since December. So, whatever gains, it kind of rose to, it kind of dropped back. I don't know why I doubled that. It kind of dropped back, back to that point, which could be good, could be bad, depending on how you sort of look at it and in your strategy. Then you've had 2 instances of the inverted yield curve, which is, I've got a video on, is a recession coming? And that talks about the inverted yield curve. So there was 2 signals this year that basically suggest potentially from analysts that a recession could be on the horizon in the next sort of 1 year, 18 months, maybe even shorter time period. You then had the Trump-China-US trade war, which obviously sent UK and European stocks that rely on international trade and exports heavily, that sent those stocks down into the oblivion, which has obviously been a very significant impact. Oh look, there's somebody using the spreadsheet. I'm glad you guys are using the spreadsheet. That's made me anyway. Let me not digress. You've had the Trump-China trade war, which obviously sent a lot of stocks into oblivion. And now, you've got Theresa May resigning. And, we know that generally the markets react to sentiment. We've covered this in 5, 10, 15, 20 of the videos. Sentiment really drives the market. It doesn't have to be about the underlying value of the asset. It doesn't have to be about the underlying value of the equity in question. Sentiment, hysteria, hype, news, that drives the market. People react to news, people react to uncertainty. And so, whether or not you feel like you've made a great investment decision, that uncertainty sometimes is the presiding factor in whether you actually make some returns or not. So, we've had in the last 6 months, if you look back, 5 or 6 really, really significant things that have, negatively affected the market. And so it's been a very, very rocky time, I would say. Just short of having an actual recession, I think it's generally been quite a rocky time in the economy for the last 6 months, which has just meant that, all of us, including myself, have either seen very, very modest growth or have seen, a decline in your return, which is obviously quite significant. You then got the fact that, there is a rising interest in cryptocurrency. There is a rising, what's probably the best word to use? Distrust for, the federal government, central banks, governments in general, which is the reason why a lot of people, put money in cryptocurrency. And you've seen that. You've seen the fact that if Trump sends 2 tweets, stocks go tumbling down, Bitcoin and other cryptocurrencies go rallying up because people would just rather hedge against fiat currencies and actually put their money into digital currency where they feel actually it's a little bit more trustworthy, not from a volatility standpoint, but from a manipulation standpoint is probably the best way to sort of put that. So that's, also happened, this year as well in the last sort of 6 months. And so when I look at my sort of portfolio performance, and in fact, what I'll do, let me just go to Simply Wall Street. It's not going to be accurate to the number, but it's going to give you, a fair indication of where my portfolio is sitting at the moment. Currently, from a capital gain standpoint, and I guys, I mentioned to you before, I'm not a dividend investor. I do have stocks that pay a dividend, which has been very, very welcome. But generally, I was looking for a return. So from a capital gain standpoint, losing £258, probably not that amount, but because Simply Wall Street numbers are a bit suspect. But let's just say 2.5% is the loss from a capital gain standpoint. Obviously, my dividends have kind of pulled me back up a little bit, which has been really, really positive. So overall, my total return is about a loss of 1.2%. So, from about a £9,000 investment, losing about £110 is basically the performance in the last 6 months. Now, what I worked out in this Google sheet, which this person is actually currently looking at, but guys, I put in another tab called monthly movements, and I'll explain the purpose of this tab, but I wanted to put another section in there as well, which I'm talking about in this video, is that what I also have added is the price I bought at originally. So this is the price that I first bought at in December when I first started investing, and the price that stock is now. I've excluded all of the new stocks that I've bought recently in the ETFs because obviously I didn't have that in December, so I didn't want that to obviously skew the figures. And in the case where I sold Man Group and then I bought Vodafone, I've decided just to nominalize that to 1. So effectively that just cancels it out. So there is no effect from Man Group or Vodafone. So just taking the other 9 stocks into consideration, currently, as you saw, I'm sort of 1.2% down. However, if I just put that money up front in December, I'd be 4.97% up. So what that's showing me is that the stocks that I selected weren't necessarily negative because I was looking for about a 10% on a year-by-year basis, and with the compounding effect to try and get about a 50% return over the next 3 to 5 years. So that was the goal I mentioned in the very, very first video. Now, with that in mind, that might actually could have been achievable. If I'm sitting at about 5% halfway through the year, that potentially could have been achievable had I just put the money in up front. I'll be sitting at 9,447 or something like that. And obviously it's a lot higher than losing £110 or whatever it's now. I'd be 600. It's about a £600 difference, which is obviously very, very, very significant. Now that sort of led me thinking, is dollar cost averaging the right strategy? is that the strategy I should continue with going forward? And I'll explain my thoughts on that later. But I also wanted to talk to you about Binance Coin. Now, I'm not a cryptocurrency expert. I've put money in cryptocurrencies in the last 2 years, like ages ago. Multiple currencies. I've invested in Ethereum, Bitcoin, Litecoin. I've invested in Ripple. Oh my goodness, I lost a bag of money in Ripple. So obviously that was one of my motivations to actually get into long-term investing. But Binance Coin was something that actually impressed me just from a business standpoint because they actually own an exchange. So they're kind of like the New York Stock Exchange of cryptos. And then they have their own coin as well. So because they charge fees and they have a legitimate business, I kind of saw Binance Coin as a business as well as a coin. And so that's the reason why I kind of bought into Binance Coin, as in the idea of that, a lot more than other currencies generally. And I was thinking back in December, you know what, I should put some money in Binance Coin. But then I thought, you know what, actually start investing in equities, and maybe that's a better thing to do long term. So had I put the same amount of money sort of under my mattress and then just invested in Binance Coin recently? And the reason why I want to use that as a comparison is that I did invest in Binance Coin in the last month, or sort of the last couple of weeks actually, and my value went up by 31%. So in the last couple of weeks, I made 31% profit solely in Binance Coin alone in the last couple of weeks. I closed the trade, and obviously, you know, that money's just sitting in my eToro account. However, I I didn't put a big amount in there. That I put just some leftover money. I think it was a couple of $100 that was sitting in there. So obviously I made 31%. So it's great from a percentage standpoint, but from a genuine money standpoint, you know, it's not that significant. Although it probably cancels out the losses that I've made currently on free trade at the moment. But then I wanted to question: had I put all of the money in Binance at the very beginning, back in December, when the price was about £5 for the coin, and now it's sitting at about what, £34 odd. How much do you guys think I would have made if I put £9,000 in Binance coin as opposed to dollar cost averaging it in free trade on the stock market? And the amount is actually shocking. When I actually worked it out, right now I'd be sitting at £54,000. And so it made me think, I could have, and I did have the money there spare, I could have put all of that money into Binance Coin in December, as I originally wanted to put some money in, but I never would have put that amount in. I probably would have put something like £1,000 in, or something a lot smaller. And literally I would have made, 600% return. So I would have, 6x'd my money effectively. And so then it makes me think, what is the point to all of this investing if, I can buy one coin and I could probably make more with that one coin in 6 months than I'm probably going to make on free trade in the next 6 to 10 years, which is, and probably longer. 6 to 10 years is probably a modest way to sort of, look at it, to be honest. And so the question comes back: is long-term investing pointless? And that is the question, I'm really, really trying to answer. Now, my conclusion with everything that I've said is the answer is no, it's not pointless. And, one thing is to always look at, risk versus reward. So obviously, if I put all of that money in Binance, it might not have performed, who knows, it would have 7x'd or 6x'd or whatever it did. It might have actually gone in the opposite direction and I would have lost all of that money. And then I'll be sitting here crying, or you may never have met me and you may walk past me in the street while I'm crying or something. You'd be like, why is that guy crying? I don't know why he's crying. And you don't realize you just walked past a guy that just lost a lot of money. So that could be, that's a very, very likely scenario that could have happened. Or, if you potentially look at other coins and other performances, they've not been as successful as Binance Coin. So, the luck of me choosing Binance Coin because of my rationale, for everyone else, you may not have chosen Binance Coin. You might have chosen Ethereum or, Litecoin or Bitcoin or, other coins that might have had a rise, but also might have had a negative performance as well. So, the risk of actually selecting that good coin or that good, trade is very, very high. And to be honest, I'd rather not ever have that burden of trying to make that one speculative, a stock pick effectively. The other factor, also, that reason why I think actually long-term investing isn't pointless, is that I think, it's helped me learn about the market. It's helped me learn a lot about the market, learn about, economics in general. Now, obviously, you guys know I do have a finance background. I have worked in banking previously. There is stuff that I already previously knew before coming into investing. So, that aside, there was a foundation of knowledge. However, that knowledge has increased. That's increased. And I think personally that's been invaluable. The other factor is that although I'm not making a profit at the moment, I haven't risked that much from a risk to reward ratio standpoint. So obviously, to only be losing £100, actually, it's not the worst thing in the world. There's a lot more that I could have done with that money to potentially have lost even more. So, relatively speaking, actually, it's not actually been that bad. And, the whole point of long-term investing is to actually be looking at 20, 30, 40-year periods. So the thing that I've learned is that maybe my theory of trying to get a certain percentage of return in 3 years actually, isn't really the right strategy for what I'm using free trade for. And I should be thinking more 15, 20, 25 years down the line, etc., which is, the real purpose of doing all of this. And from that standpoint, I think another benefit is that it does make you a lot more disciplined. It makes you disciplined in saving. It makes you potentially disciplined in your expenditures because, rather than, go to a restaurant or whatever and spend, buy an extra bowl of shrimp or something, which is probably something I would do. You would actually potentially see the value of that money a bit more and actually put it into the market and actually start considering and thinking about your future. So, I definitely think long-term investing is worth it. I think it's all about, really understanding your goals. And I say this to you in multiple videos. Understanding your goals and your objectives and why you're investing is the most paramount thing to do. It's like jumping into a car and trying to know what your destination is. You will find the quickest route to your destination. You will avoid traffic. You will avoid an accident. You'll avoid going through, a dodgy, sketchy area or whatever, and potentially get carjacked. I don't know why. The reason why I said that is because I've been playing GTA 5 recently, so that's probably why carjacking is on my mind. However, you will avoid all of those negative things if you have a specific destination, and the stock market is no different. And so, reevaluating your stocks, reevaluating your decision making, more importantly, and trying to understand why you made specific choices, I think is absolutely crucial. So yes, currently I'm losing a bit of money. I would have made a bit more if I just put all of that money in up front, but as a new investor, I would never have done that, to be honest. And so for me, I prefer that I've actually taken this approach and I've learned about the market along the way rather than just putting in. However, in 2020, I might make a different call. I might save some more money in cash, and actually when it comes to 2020, put a few lump sum amounts in a few different stocks that I believe fit the same criteria that I've been looking at. It's worth noting, I don't actually believe my criteria has been negative, and I don't believe that I've picked bad stocks. If you look at the stock performance, generally speaking, apart from, a mining stock and a tobacco stock, and one bank, at a 6-month point, they've all been good. And, one time Barclays was in profit, one time Sentiment was in profit, one time Imperial Brands was in profit. So, generally speaking, I don't think I've had any real bad stock selections. I just think maybe the dollar cost averaging approach is a very risk averse approach, and maybe that's not the best way to actually realize some gains rather than putting that money up front. So next year I might do something differently. I'm still going to dollar cost average this year. I want to keep that clear. I'll still add some money in every single month. and keep on, using the same approach for this year. But when it comes to the 12-month mark, I'll then do the same exercise, reevaluate where I'm at. And for 2020, I might take a whole different investment approach and investment strategy. And, it's like exercising. It's a muscle. You have to learn. You have to try and progress and, do things the right way. Will I invest a further sum into cryptocurrency? Probably. I'll probably put some money into cryptocurrency. But maybe down the line, maybe there'll be a new Binance coin in 2020 that, will really, really shake things up. And that's something that I might potentially look to invest in or whatever, etc. What I will say is always to make sure, and I've said this in previous videos, and I'll reiterate it, always to make sure you have money in cash. Do not invest all of your money. Like when I put a certain amount in, I put it in with the comfort and the peace of mind knowing that I've got, a lot more than that sitting in cash that I can draw on at any time. If any situation happens that I need to get some money out and, fund, a part of my lifestyle, whatever that may be, then obviously I don't need to go and touch the money in stocks. I can sort of manage that separately. And I think that's really, really crucial that you don't, if you have say £3,000 lump sum at the moment, that you don't just put £3,000 in stocks straight away. That's personally what I wouldn't do. I would maybe put, I don't know, £1,000 in stocks, but keep 2,000 in cash. And then if you earn a monthly salary, just put a percentage in stocks and a percentage towards your cash balance, just to make sure that, you're diversified. But also, you've got that protection there. But let me know your thoughts. Is long-term investing worth it? Is there anything you guys would do differently with your stock selection? Some of you guys have been investing since I started investing. Some of you guys were investing before me, which I've always loved to hear from you guys as well. Some of you guys are brand new, brand spanking new, probably like this anonymous mink right here. And so, I think, the key principles I want to get across to you guys is always be reflective, always reassess everything you've done. Do not just take someone's advice and go and do it, willy-nilly, and then just be shocked that things didn't work out or it did work out. If it did work out, it might be luck in that instance. If it didn't work out, it probably was your own error. I would say as well, just make sure that you play, your risk reward safely. Make sure you keep some money in cash. Make sure you have some money when things do take a downturn that you can invest in. And always try to, build up your knowledge and just think long term. Think long term. Do not think of it as a get rich quick scheme. Sure, there are people investing in cryptocurrency and making a whole heap of money right now. But, the likeness is that if I did that and I made a lot of money, I would put that money into another coin and potentially lose it and be back at square one. You never know what could happen. So, I think it's always about discipline and thinking long term. And I think that in the long term, it's kind of like the hare and the tortoise. Slow and steady wins the race, right? So, let's win the race at some stage in the future. But get in the comments. Please like, please comment, please subscribe. I will come with a portfolio update this week. I have added some new stocks. I bought some new stocks, which I said I would do. I bought some new stocks this week. So I will do a portfolio update and let you know the new stocks that I've bought and my rationale for buying those stocks. And yeah, if you've got any questions, any messages, any comments, then definitely leave that in the comments below. Other than that, have a good day, have a good afternoon, evening, and wherever you are. And I'll catch you next time. Happy investing. Take care, guys.